Okay guys, so perhaps one of the most important things that you will learn in your trading journey is being able to understand risk and manage that risk. Okay, so how much risk do you take per trade? How do you work out your risk-reward ratios? Now, generally people are very scared of risk, but they have to understand that in order to gain some rewards and gain some returns, there has to be some risk associated with that. So they have to be willing to take some risk. Okay, now there is often a direct relationship between risk and reward. So the more risk that you take, the more returns or rewards you will seek to gain from that risk. Okay, so if you look at investment portfolios, mutual funds, higher risk strategies when you're looking at investments, things such as, if you're investing in commodities such as gold, oil, silver, wheat, emerging markets such as India and China, new startups, small cap companies, they're all examples of high risk strategies when you're looking at investments. So if you're taking that high risk and investing in these things, you will look to gain a higher return on your investment. Okay, now on the other hand, if you're investing in blue chip companies, companies such as Nike, Apple, Amazon, that have been established for a while and are very sustainable companies, they have very low risk associated with those, or at least lower risk than the ones mentioned previously. So for that, again, when you look at it hand in hand, because there's lower risk associated with it, often you'll look to have lower returns. Bonds and gilts are examples of even lower risk investments, especially when associated with very strong governments and companies. So again, because there's very little risk involved in these investments, you're looking at very, very small returns as well. People nowadays think it's very safe to, or risk-free, to be putting money into their savings accounts and leaving it there rather than investing it. But what they don't understand is the effect that's having on eroding against inflation. So the savings are eroding against inflation, especially when we're living in a low interest rate environment like we are today. Okay, so if you look at your savings account or your bank account, you're receiving around 0.25%. Okay, now if you look at the inflation rate set by the Bank of England, which is around 2%, which basically means the products and services are increasing by 2% every single year, and your money is only growing by 0.25%, you can see that you're losing money against the rate of inflation by minus 1.75% per year. Okay guys, so as I mentioned, there's different ways of investing, different ways of taking risks, different strategies that you employ. Now similarly with trading, different traders will take on different amounts of risk. Now it's important to note and important to understand that it's okay to take a little bit of risk and it's okay to take a little bit more risk. It just comes down to the personality amongst many other factors of the trader themselves. Now one of the factors to consider is the age. Now how old are you? How far are you away from retirement? Okay, now if you're very close to retirement, it doesn't make sense to be taking on too much risk because safeguarding and protecting your capital becomes more important. Now if you're younger and you have a long time till retirement, then you can take on a little bit more risk because even if you lose a little bit more money, then you have a lot more time to make that money back. Okay, now what is your personality in terms of the emotions that you go through? If you lose a bit of money, how do you react? Okay, some people just hate the thought of losing money. Now, if you're one of these people, then you'll probably take on a little bit less risk, okay, and that's totally okay, but you just have to be accustomed to generating lower returns. Some people are totally fine with this, they just don't want to lose too much money, they just want to make a little bit more money on the side, maybe to pay for bills, an extra couple of holidays a year, that's totally fine. Now, there's other people that just aren't content with a little bit more money. So they want to make life-changing money. Now, although this is possible, understanding the risks is crucial when you're actually looking to generate higher returns. Now, there's other factors such as dependence. Okay, so how many mouths do you have to feed? Okay, other things such as outgoings, how many liabilities do you have? Now, if these numbers are quite high, then it's not advisable to take on too much risk. Now, another more obvious factor is disposable income. So disposable income, in short, is the money that you have left over after your spending and outgoings, okay? Now, losing £1,000 for person A might be completely different to losing £1,000 for person B. Okay, so it depends on their financial backgrounds, how much money do they have in the bank. But generally, the more disposable income that you have available to you, the more risk that you are willing to take. Now, developing your own personal risk profile and risk tolerance is crucial. So just consider the factors that I've mentioned above, go through them all, and develop your own risk tolerance that you are comfortable to manage. So I just wanted to talk about inflation in a little bit more detail, and you're going to see me cover it in various chapters throughout this course. And that's just because I think it's very important when it actually comes to trading, when it comes to investing, and when it comes to money management in general. Okay, so firstly, what is inflation? Now, inflation is the steady rise in price of goods and services. It's measured by the CPI, which is the Consumer Price Index. It measures a typical basket of goods and services that a typical household would order. Okay? Now, steady inflation is actually very good for the economy. It shows that the businesses are thriving and that the economy is growing. So the Bank of England sets its inflation rate at around 2% per year. Okay, now when it gets above this, it shows that the economy is actually expanding out of control a little bit, or at least outside the target boundaries set by the Bank of England. And that's when they'll get together with the Monetary Policy Committee, the MPC, and they'll review their monetary policy and actually increase the interest rates to constrict the economy again. Okay? Now, let me just go through in a little bit more detail why inflation can be very dangerous if you do absolutely nothing with your money. So, you can imagine now that we're living in a very low interest rate environment. Okay? When you're looking at savings accounts and your bank accounts, you're generally getting around 0.25, and if you're lucky, 0.5% per annum on your savings. Okay? Now, as I mentioned, the target inflation rate is actually 2% per year, but your savings account are only generating 0.25 to 0.5% per year. So let's illustrate this in a diagram just so you can see how much of an impact this has on your savings if you do absolutely nothing with it. Okay, so at the bottom here, we're going to have your bank account. Okay, so say it's generating 0.25% per annum. Okay, and now look at the target inflation rate, which is set at 2% per year. Okay, so every single year, your money is actually increasing by 0.25% per year. You might think, great, but everything is ending up costing you 2% more. Okay, so now if we look at an example of this, if you imagine a Coke can 10 years ago, it might have cost you around 40 pence, okay, 30 to 40 pence. Now, if you buy a Coke can, it's going to cost you around 80 pence. So that is an example in inflation, and the steady rise in price of that goods and services, in this case, the Coke can. Okay, now everything is going to cost you 2% per year, but your money is only increasing by 0.25% a year. Now, this poses a very clear problem, okay? So if you leave your money in your bank and do absolutely nothing else with it, the value of your money is actually decreasing in value by minus 1.75% per year. Okay, now my exact point about this is that a lot of people think it's very safe to leave your money in your bank accounts, okay? When you look at the inflation-adjusted returns that you're receiving, okay, you're actually losing value of your money. So you're guaranteeing yourself a loss by leaving your money in your bank account. So what do we do about it, okay? Now, the best thing to do with your money is to invest it, okay, to make that grow past at least the rate of inflation. Now, when we do this, we typically earn a return of, say, around 8% per year. Now, if your money is increasing by 8% per year, inflation, goods and services can still be increasing by 2%. That's totally fine, because compared to everyone else, okay, there will still be 6% cheaper for you. Now that's the whole point of actually making your money work for you, at least up to the rate of inflation, so nothing is actually going to cost you more in practice, but in fact growing above that rate to make sure that things are going to cost less for you. Okay, so now I hope that you understand how inflated adjusted returns work and how inflation actually erodes your savings if you do absolutely nothing with it. And that's when trading and investing comes into play.